Welcome everyone to KPMG's Accounting and Reporting webinar series on not-for-profit accounting and reporting issues, Part 1. I would now like to hand over to your host, Kim Heng. Kim, over to you.
Welcome. I'm Kim Heng and I will be your host for today. I'm a partner in our Department of Professional Practice, a group that helps clients and KPMG staff with interpreting and applying IFRSs and other financial reporting requirements. Joining me today are Julie Locke, a senior manager in my team, Stephen Isaac and Catherine Dean, fellow partners with clients that operate in the not-for-profit private sector, and Shara Limons, a director also with a focus on clients in this sector. Many of you will have joined us in the past for our reporting webinars. This season, we are presenting a two-part series on issues facing private sector not-for-profit organisations, with Part 1 being presented today and Part 2 on the 20th of April. Your not-for-profit private sector has been bombarded with proposed changes and consultations on numerous issues over recent years. Many of the sectors your organisations operate in have also been subject to increased scrutiny and review from an operational perspective. We only need to look to the topics of some of the most recent Royal Commissions to identify the issues. And that is before we even consider the impacts to your activities and ability to operate effectively in this COVID era. Adding to that, you may have found the pandemic has increased the demand for the services you provide and the purpose which your organisation exists. The government continues to allocate resources to ensuring compliance with both the taxation and regulatory requirements, actively monitoring these aspects of your business. Your financial reporting obligations have not been immune to change and proposed change either. It seems like the Australian Accounting Standards Board has been discussing a new financial reporting framework for many years, and we are now finally seeing a renewed focus on what it will look like for your sector. One of the key aspects will be the finalisation of the revision of the definition of not-for-profit for accounting purposes. And let's not forget the challenge that you have risen to recently in applying the new accounting standards on revenue and income. The demand for financial reporting transparency has not escaped this sector either. Demonstrating and communicating stewardship to your stakeholders with clarity and at an appropriate level of detail and telling your story is all part of the ongoing challenge. Given this context, we have developed the agenda for each of our webinars in the two-part series to cover both a mix of current reporting and operational topics that we believe will be of interest to many of you on the call. With all this in mind, let's look at our agenda for today. In today's webinar, Julie will discuss some of the practical challenges we've been helping clients work through in applying the income recognition standards. Shara and Steve will discuss important considerations for achieving financial reporting transparency more broadly. Catherine will explain areas where not-for-profit regulators are focusing their compliance activities and also talk through topical tax issues relevant to not-for-profit organisations. And then we'll wrap things up and respond to your questions. If you have any questions, please submit them using the Q&A function, and we will try to address as many of them as possible at the end of the webinar. If we do not get to your specific questions, then we will answer them through your usual KPMG contacts separately following today. Next week, we'll be uploading both the recording of this webinar and the slides to our external website where you will be able to access them. I'll now hand you over to Julie.
Thanks, Kim. The two accounting standards guarding the recognition of income for not-for-profit organisations are AASB 15, which is revenue from contracts with customers, with its specific not-for-profit application guidance, and the bespoke not-for-profit income standard, AASB 1058. Both have only been enforced for 18 to 24 months, depending on your reporting year-end date. In helping our clients apply these accounting standards, we came across a number of challenges. The two assessment junctures we keep getting questions on are, not surprisingly, whether an arrangement is enforceable and the existence or not of performance obligations that are sufficiently specific. The other area of practical implementation challenge that we kept coming across was having concluded that an agreement was in the scope of the not-for-profit income standard, that is the AASB 1058, when is there a financial liability to recognise? With this assessment impacting the amount of income that you can recognise. So let's look at enforceability and sufficiently specific performance obligations first. As a reminder, you can see on the slide the flow diagram that we have presented in previous webinars. We find the flow diagram is really helpful in stepping through the thought process on whether the transaction is in scope of which of the two income recognition accounting standards. We are really focusing on those middle questions. The first being, does the agreement contain enforceable rights and obligations? Because if not, then AASB 1058 is the accounting standard to apply. But if it is enforceable, then the next question we need to go on and look to is whether the agreement requires you to fulfill sufficiently specific performance obligations. And as with the enforceability question, if the answer to that is no, then AASB 1058 is going to be the accounting standard to apply. However, if the answer to that question is yes, then the agreement is accounted for by applying the requirements of the revenue standard, AASB 15. So it is important to work out the appropriate standard to apply, because if you apply the not-for-profit standard, the 1058 standard, income is usually going to be recognised immediately when you receive the cash. But if you're applying the revenue standard, AASB 15, you're more likely to recognise income over time as you perform a service or at the end of the arrangement. So we've discussed both these concepts in our previous webinars, which are able to be accessed on our website. However, today we wanted to share further application challenges that have emerged. Often an organisation could receive funds where one or more of the promises in the arrangement may appear incidental, and the value of those promises do not correlate to the amount of the funds received. So such a promise may be determined to be not sufficiently specific, which could result in the whole arrangement being accounted for under AASB 1058. So I think it would be helpful to look at an example to explore this issue. So if we assume that we have a not-for-profit organisation, an arts council, whose objective is to provide spaces and opportunities for artists to exhibit their artwork. The Artful Arts Council has an existing multi-gallery building and has received a $2 million donation from a publicly known entrepreneurial supporter to partially fund the construction of a new art gallery space. The newly built art gallery must be used by the Arts Council in furthering its objectives, and the donation is refundable if it's not used for the purposes expressed in the agreement. As part of the agreement also, the Arts Council promises to hang a plaque somewhere within the new building for a period of 10 years to acknowledge the contribution by the donor. So the question that we're going to be thinking about and considering is whether a sufficiently specific performance obligation there is one relating to providing the plaque. But before we look at that question, I can hear you all saying, hold on, this looks like it's a capital grant, isn't that what it is? So yes, for those familiar with the specific criteria in AASB 1058 relating to capital grants, from the specific use and enforceability criteria, together with the fact that the Artful Arts Council gets to keep the constructed art gallery for its purposes and not transfer it back to the donor or another third party, the income related to the grant portion would be deferred and recognised as you satisfy the obligations under the agreement. But what about that plaque? Is there a sufficiently specific performance obligation relating to providing the plaque? To help us answer the question, the Artful Arts Council would need to determine what would happen if the plaque was not hung for the promised 10-year period. Is the hanging of the plaque able to be enforced by the donor? And if it is, what value would be attributed to the hanging of the plaque? I guess it is possible that the presentation of the plaque is concluded to be incidental to the purpose of the donation, and therefore the arrangement does not contain sufficiently specific performance obligations. This conclusion might be reached if, for example, Artful Arts Council offered to provide the donor with the plaque, rather than the donor requesting the plaque in return for providing the $2 million, which may be an indication that there are no consequences to the Artful Arts Council if the plaque was not provided, and that whilst the whole arrangement is enforceable, the provision of the plaque is not sufficiently specific. So accordingly, this agreement might be accounted for under AASB 1058 in its entirety, where there would be no deferral of income relating to the $2 million donation beyond the completion of the construction of the new art gallery. Other arrangements may have different facts and circumstances, which could lead to a different outcome. Kim, when you've worked through similar fact patterns, what key things did you consider that might produce a different outcome?
Thanks, Julie. Understanding all the facts and circumstances of agreements and assessing what promises are enforceable and sufficiently specific can often be quite judgmental, with significant consequences for whether the entire amount is in the revenue standard or whether any allocation of the donation between the revenue and income standard is needed. In the example we just considered, it was an individual who made the donation, and we assessed that the plaque was incidental to the arrangement. Sometimes donations are made by corporates in return for the new art gallery, say, or a wing to be named after the corporate donor for a specified period in recognition of the donation. And there would be consequences for the not-for-profit if this promise was not fulfilled. Such a situation may need to be thought of in a similar way to a sponsorship naming right of a sports stadium, which would likely be viewed as a sufficiently specific performance obligation, probably with much of the amount accounted for under the revenue standard AASB 15. Other arrangements might include other benefits, such as tickets to art exhibitions of the art gallery or other preferential opportunities, and a similar assessment of whether such promises are incidental or integral and enforceable in the arrangement would be required. We sometimes get asked whether an acquittals process will mean that there are always sufficiently specific performance obligations and therefore would be accounted for under the revenue standard. To which I've answered that an acquittals process in and of itself will not ensure sufficiently specific performance obligations exist. Such grants will also need to be put through the flow diagram that Julie took you through to determine whether the grant is in the revenue standard or the income standard. Back to you, Julie.
Thanks, Kim. So another question that we have been asked is around what impact, if any, deductible gift recipient or DGR status of an organisation may have on income recognition. The question is, really whether all amounts donated to a not-for-profit having DGR status are automatically accounted for under the not-for-profit income standard. So because the donor will be getting a tax deduction, does that mean that from the perspective of the not-for-profit organisation, there is no sufficiently specific performance obligation promised to the donor and the receipt will always be to further its objectives? An entity or fund having DGR status could receive a donation in various forms. And to work out how to account for the donation, we need to understand whether the agreement relating to the donation is enforceable and whether there is a sufficiently specific performance obligation. So let's have a look at 3 different donations or contributions that may be received in 3 different forms. The first that we have is a $100 cash donation that may be used as the not-for-profit determines. In this circumstance, the donor is able to get a tax deduction for the amount of the donation. The second example is a $300 ticket to a fundraising dinner. The donor will receive a dinner as part of the arrangement, but the amount paid for the ticket is more than the cost of the dinner as there is an element of donation in the price of the ticket. In this case, the donor will receive a partial tax deduction for the amount of the ticket if the benefit is not material, and that is judgment is in accordance with the ATO's view of material. And the third type of example that we're showing is a $1,000 cash given to sponsor the fundraising dinner. The corporate sponsor will receive signage at the dinner and recognition on all media promotions to acknowledge and recognise the sponsoring of the dinner to the value of $1,000. So each of these amounts would need to be separately assessed from an accounting treatment perspective so that the appropriate income accounting and recognition of income can occur. So I'm not going to go through the detailed analysis for each donation, but you can see from the assessment of enforceability and whether there is a transfer of good or service to the donor or a sufficiently specific performance obligation determines which accounting standard will be applied to work out how and when the income is recognised. There is specific guidance Also, where a donation has a dual purpose of obtaining goods or services and to help the not-for-profit achieve its objective, such as our fundraising dinner example. This guidance results in an allocation between the promised dinner, which is recognised as income when the dinner happens, and the donation, which is recognised as income straight away. Again, I'll refer you to our 2017 webinar if you'd like to understand this allocation consideration in more detail. So from this, that we can see that it would not be appropriate to just conclude that because your organisation has DGR status must mean that all the transactions would be in the scope of AASB 1058 and income be recognised immediately. I'll also just note that Catherine is going to discuss a little bit later some further considerations of DGR status from an operational perspective. So this brings us to our other application issue that we have worked through. One which is a direct consequence of the way in which AASB 1058 works and the process it requires us to step through as we apply the standard. In general, this could apply when you receive a grant that requires you to pass some or all of the funds on. The scenario that we're going to look at is an arrangement that is determined to be in the scope of the not-for-profit income standard. And what the standard requires you to do, as you can see from the flow diagram, is to firstly recognise the asset that you've received. So for example, if a cash grant is received, then it meets the definition of a financial asset and will be recognised at the nominal value of the cash. The next step in the process is to recognise any related amounts in the agreement. Again, this is required to be done in accordance with other Australian accounting standards. And there are a number of specific examples that are given in the standard. One of those examples is a financial instrument in accordance with AASB 9. And I guess in the context of what we're looking at more specifically whether a financial liability needs to be recognised. As I said initially, this is actually an important consideration because if a financial liability is recognised, the income could be that little or no income is recognised in the income statement by the organisation. So again, let's look at an example to help us understand. So let's say that here we have a foundation which has the objective of supporting domestic violence victims. The foundation raises money through various fundraisers and also by seeking donations. And these funds are given to specific charitable organisations that provide services directly to victims of domestic violence. In March, the foundation enters into an agreement with a donor to receive $5 million on the 1st of April. And the agreement requires that the funding be given to another third-party not-for-profit organisation for constructing an accommodation facility for victims of domestic violence. If the funds are not used for these purposes, then the funds must be returned to the donor. The third-party not-for-profit organisation receiving the funding will have no connection to the foundation, and the foundation will not have any claim on the asset that is being constructed. The agreement also allows the foundation to retain 5% of the funding to cover its own administration costs. The specific third-party not-for-profit organisation that's going to be doing the construction, the timing, and the amount of payments are not explicit in the agreement. These are all decided by the foundation in meeting the terms of the agreement with the donor. As there are no sufficiently specific performance obligations, the contract is accounted in accordance with AASB 1058. So the question that we're looking at is, should this $5 million donation be recognised as a financial liability on the 1st of April? When we consider the definition of a financial liability in AASB 9, the question we're actually looking to answer is there a contractual obligation to deliver cash to another or another financial asset to another entity? So when we are making this assessment, some of the questions that we need to consider are, who gets to decide who receives the funding? Who determines the timing of the payments by the foundation? And who determines the amounts of those payments? In our scenario, if you recall, we would probably conclude that there is no financial liability to recognise. the $5 million would be recognised as income immediately. And this is because all these decisions are determined by the foundation. While the total amount of the funding and the purpose of the funding is set out in the agreement, there is still a lot of parameters that are determined by the foundation. Also, there is no time frame by which the funds need to be paid on, which adds to the question of reliable measurement of any liability and also the enforceability of such a liability. Again, other arrangements may have different facts and circumstances, which could lead to a different outcome. So Kim, in your experience, what are some other scenarios that may produce a different outcome?
Thanks, Julie. Can't reiterate enough how important it is that when you are looking at a circumstance like this, the assessment should be focused on how much discretion there is with regards to distribution of the funds. For example, what if the recipients of the distribution had to meet certain specific objective criteria that were set out in the agreement from the donor, and the agreement from the donor said that the distribution was required to be provided to the first applicant that met the criteria? Would the impact be different? Would there be a financial liability here? And yes, potentially, because here the not-for-profit had little discretion about the distribution, and it would seem to meet the definition of a financial liability. Or what if the amounts and timing of the amounts to be paid out were specified in the agreement with the donor? Would the definition of a financial liability be met? To me, the specification of the timing of the payment would likely make it a financial liability. The conclusion is not always going to be straightforward, and more often than not, judgment will be required. The final point I'd like to make on this scenario is how the income statement could collapse if the conclusion is that a financial liability exists. Previously, these donations to and grants by a foundation may have been accounted for gross in the income statement. That is, the donations would have been recorded as income and the grants as expense. And it would have been quite transparent from looking at the income statement what cash had come in and what had been dispersed out. Under AASB 1058, this may not be the case anymore. Where a financial liability is recognised on receipt of the donation and de-recognised on payment to the third-party recipient, it is likely that no amounts will be recorded in the income statement. That is, the income statement will be net. Later, Cheryl will discuss the importance of expanded disclosures in such circumstances. To echo Julie's observations, while our example illustrates our foundation, similar issues could arise for other types of not-for-profit organisations. Essentially, it could apply when you receive a grant that requires you to pass some or all of the funds on. For example, we recently dealt with this issue for a sporting not-for-profit who, under the agreement, had to make a donation to a grassroots sporting organisation, and we concluded in that situation it was a financial liability. We'll talk more about other practical implementation issues in part 2 of our not-for-profit webinar series in April. For now, I'll hand you over to Shara and Steve.
Thanks, Kim. We'll now take you through some of the financial reporting developments we're seeing within the not-for-profit sector and the emerging transparency agenda. In recent years, there have been significant corporate reporting reforms taking place around the world. These reforms have been focused on improving communications with all stakeholders by removing unnecessary clutter and immaterial disclosures, and improving transparency through reporting around the business model, strategy, performance, and the value being created. This has been accompanied by a general acceptance that financial statements alone no longer provide enough information for users to determine how the organisation has performed. This is especially relevant in the not-for-profit sector, where success isn't measured by financial performance alone, but rather through a series of outcomes you are seeking to achieve, with financial performance being only one element of that measure of success. Over the last couple of years, integrated reporting has been gaining global attention and adoption as a way to help organisations better communicate the value they create and to demonstrate how they are set up to be sustainable in the long term. Current royal commissions and related media exposure focused on the not-for-profit sector in the ageing and disability space has highlighted the desire from taxpayers for increased focus on transparency around the effective use of government funding. There is also increasing demand from donors, funding bodies, and the general public to see more information on the outcomes achieved by not-for-profit organisations. From an Australian standpoint, there are a number of developments in the pipeline with a focus specifically on the not-for-profit sector. These aim to create more consistency and comparability in application of financial reporting requirements, as well as creating better transparency in achievement of objectives. Our webinar in April will delve into these forward-looking projects in a bit more detail, but I will briefly touch on a few of those now for some context. Firstly, there is a new definition of a not-for-profit on the horizon. An exposure draft, ED 291, was released in June 2019, which proposed a new definition for a not-for-profit entity, along with implementation guidance and illustrative examples. Since the initial release of the exposure draft, there have been some proposed amendments to that definition to create better alignment with not-for-profit entity concepts already applied by the ACNC, the ATO, and other regulators. Why this is important is that classification as either a for-profit or not-for-profit entity determines which accounting framework and which accounting requirements it applies. For example, only a not-for-profit entity would apply AASB 1058 that Kim and Julie spoke to earlier. This will also determine whether entities will be in scope for any future proposed service performance reporting standard. The finalisation of the definition, along with implementation guidance, will be further deliberated by the AASB in the first half of this calendar year, at which point further information on the final definition and timing of implementation will likely be known. So watch this space. The Australian Financial Reporting Framework was recently finalised for for-profit entities, which includes the introduction of the new Tier 2 simplified disclosures for for-profit and not-for-profit entities, that's AASB 1060, and the removal of the Special Purpose Reporting Framework. We will take you through the implications of this in more detail in our next webinar in April. However, with that project now finalised, the AASB has now turned its focus to the development of a not-for-profit specific financial reporting framework. To date, tentative decisions have been made around retaining the existing 2 tiers of reporting, that's Tier 1 and Tier 2. In addition, it is proposed that a further reporting tier, Tier 3, would be developed to accommodate those entities which may not be able to prepare special purpose financial statements in the future. However, what that third tier will encompass is subject to further deliberation, with a consultation paper expected towards the back end of this calendar year. Tied to the not-for-profit financial reporting framework is the decision to restart the project on service performance reporting, which was originally released in an exposure draft, ED 270, in 2016. At the time this exposure draft was released, there was significant negative sentiment regarding the necessity, burden, and application it would require for the not-for-profit sector. This current project will be delivered separately from the financial reporting framework. The objective of the project is to close the performance reporting gap by providing key financial and non-financial information that is useful for accountability and decision-making purposes. The AASB's view is that reporting of service performance information is useful to users of financial statements of not-for-profit private sector entities and further indicates the desire for greatest transparency in financial reporting of entities whose key objectives go beyond financial performance. We expect there will be a lot of engagement by the AASB with the sector to understand the concerns expressed in the submissions on the 2016 exposure draft, so that any resulting standard is fit for purpose and not merely more regulatory burden or red tape for the sector. So again, watch this space. I will now hand over to Steve, who will touch on how you can start preparing for the future now.
Thanks, Shara. So as you've heard from Shara, there is some significant change coming. Today, across our clients, we see a wide range of practice within those in the not-for-profit sector, between those who voluntarily report additional information in their financial statements and those who do not provide any additional information, for example, around service performance measures. Whilst the Director's Report is not an ACNC requirement, in our view, it is seen as better practice as it allows organisations the opportunity to tell their story. We are also seeing some organisations voluntarily apply segment reporting, either in their Director's Report or in their financial statements, to better show their story. And this is particularly relevant when there are multiple different business streams within the one not-for-profit organisation, as this helps further enhance transparency. So what can you do now? So in order to prepare for the future, there are some steps we believe that you can take. From a financial statements perspective, you can start streamlining and simplifying your financial statements by cutting the clutter, which involves grouping together relevant accounting policies and notes. For example, having a revenue policy in the same section as your revenue notes, as well as removing immaterial disclosures that may have aggregated over time. Secondly, we think you can actually look at the language used in your financial statements to remove jargon and technical language to ensure that your disclosures are understandable by your users. And then thirdly, we think you can consider what additional information you can add to help bring your story to life. So for example, Kim spoke earlier about a scenario where the profit and loss statement could be collapsed in certain circumstances. In this scenario, we would suggest you would want to add additional disclosures to tell the story of what donations you've received and the corresponding grants you've made that may not necessarily be immediately visible within the requirements of the financial statements. You may also like to draw on some of the concepts of integrated reporting. One of the key concepts of integrated reporting is about how you create value for others. And all organisations depend on various forms of capital for their success. These are the various resources and relationships that the organisation relies upon when producing their goods or services. The integrated reporting framework has identified 6 broad types of capitals, as we have shown here on the left-hand side of this slide. And it is this idea of the 6 capitals which sets integrated reporting apart from other forms of reporting. For example, traditional financial reporting typically covers financial capital and manufactured capital, whereas for the not-for-profit sector, it is more the human capital and social relationship capital which is critical to how you create your value. We believe that today you can start building out metrics relevant to your users by understanding your business model and identifying the resources and relationships you rely upon to create value, by clearly documenting the outcomes you are seeking to achieve, and also by determining how the outcomes you achieve will be measured, for example, through a series of financial and non-financial KPIs. We believe that having these steps in place and having done the thinking will ensure that if there is a transition to a requirement for service performance reporting, this can be more easily achieved. But we also believe that better forms of reporting already start to embrace these concepts today. Now, if you want to see these concepts brought to life, we would point you in the direction of Camp Quality, which is an excellent example of a not-for-profit organisation that has leveraged the principles of integrated reporting to bring their story to life and show their users how they're performing against their objectives. With that, we'll now change tack slightly, and I'll hand over to Catherine to talk around some tax matters specific to not-for-profit organisations.
Thanks very much, Steve and Shara. Catherine Dean here from the Corporate Tax Practice. As noted, one of my specialty areas is dealing with not-for-profits, and there are a range of specialist issues in this area. I'm just covering some of those areas today. Obviously, there's a number of specific things that, such as relating to employment taxes, GST, even compliance with fundraising receipt requirements that was referred to earlier. So today I'm going to be covering off on 3 key issues. The first is some trends that we're seeing in the charities and not-for-profit sector. The second is a refresher on the so-called In Australia test for charities and other not-for-profits, because it's a question we often get asked. And the third is a focus on the ACNC governance framework, some changes in that space that are proposed, and some charity health checks that we do here at KPMG. So firstly, just looking at some trends in the not-for-profit sector, there are currently over 58,000 charities currently on the ACNC register, and the number of charities is growing by around 4% a year. Now that number doesn't include the not-for-profits in Australia, so there are many more entities that don't qualify as charities that are currently not regulated by the ACNC. There are some discussions as to whether the ACNC may expand its scope to regulate other not-for-profits, but currently it just covers charities. With that amount of charities in Australia, there are concerns around duplication and also competition between charitable organisations for donations and grants funding. We are seeing some trend here towards consolidation to simplify processes and reduce red tape. Obviously, when you've got so many entities for tax, it's considerations in relation to reporting. We're also seeing charities commonly acquiring for-profit companies and businesses, and also engaging in commercial activities to further their charitable purpose, broadly to make up for sometimes some grants and revenue funding shortfalls, and to diversify their revenue streams. So I've just included a graph there from the ACNC on the growth we're seeing in the charity sector. So moving on to the In Australia condition, about 18 months ago, the Tax Office put out finalised a draft ruling. It was finalised in Taxation Ruling 2019/6, which was contained some details of how the ATO will interpret the In Australia condition. Now, this is a requirement for charities and other not-for-profits, and also extends to deductible gift recipients. So it's important to consider here that there are actually 3 tests. So if you're an organisation that has got deductible gift recipient status, broadly you have to be in Australia before a gift or contribution that's made is tax deductible to those donors. And in relation to that test, deductible gift recipients must be established and operated in Australia. Now, this condition generally does not require charities to have purposes or beneficiaries in Australia. So you could be a deductible gift recipient as long as the board and operations and management of the charity is in Australia. That is fine if, for example, all of your funding is to offshore beneficiaries or purposes overseas. So that's for deductible gift recipients. The second condition is for other Division 50 income tax exempt entities. So entities, there are a number of not-for-profits that are not charities. They've got a slightly more onerous in Australia condition in that they have to have a physical presence in Australia and incur their expenditure and pursue their objectives principally in Australia before their income is exempt from income tax. Now, in relation to that, that does mean then that their expenditure has to be principally, meaning mainly or chiefly, i.e. more than 50% in Australia. So that's an important one to consider, particularly where your charity is considering, or your not-for-profit is considering some offshore expansion plans. The third category, which often doesn't receive a lot of consideration is for charities or deductible gift recipients that are claiming a refund of imputation credits. So that can be quite a large source of funding for some charities to have a share portfolio and to derive benefit from the refundability of franking credits, which applies to certain eligible charities and deductible gift recipients. Now, for those charities who are wanting to access that measure, they need to have both a physical presence in Australia and again incur their expenditure and pursue their objectives principally in Australia. So there is a higher standard for those charities seeking refundability of imputation credits, an important one to bear in mind when you've got significant share portfolio in Australia. So on the third point I'm going to cover today, it's an overview of the ACNC governance framework. I'm going to set out the 5 governance standards, highlight some key areas and also some changes in this area, and finally just focus on some areas we consider when we do a health check of charities and not-for-profits. So in terms of the 5 areas of the ACNC governance standards, there are 5 key standards. The first is that charities must be not-for-profit and work towards their charitable purpose. So that is, the charity needs to be run as a not-for-profit and provide reassurance to the public through making information available about their charitable purpose. They also must not operate for profit, gain or benefit of particular people. And this is one where we often do encounter examples, and certainly it's something the ACNC picks up, where charities may have, for example, made inappropriately high payments to related individuals, and that can put at risk the charitable status of an entity. So the ACNC recommends, in relation to Governance Standard 1, the following steps to ensure this standard is met. So inclusion of a charitable purpose and not-for-profit clauses in the governing documents. Now, ordinarily this would be done in order to get charitable registration. Updating any changes to governing documents with the ACNC. Ensuring the charitable purpose and not-for-profit clauses are followed by the charity in practice, and that might be reviewing expenditures and the way the charity is actually carrying out its charitable objects. And finally, providing information through the charity's website or through social media on actually what the charity is doing. Secondly, charities have to take reasonable steps to be accountable to their members. That is, the ACA wants to know that a charity is acting and using its resources, its financial resources and other assets on behalf of those members. So in order to ensure this governance standard is met, the ACNC recommends an annual meeting of members to identify with members any opportunities for members to ask questions and vote on resolutions, to provide information on the charity's activities and finances, and to also have clear processes in place for the appointment of responsible persons such as board members or committee members. In relation to Governance Standard 3, this is a standard that requires charities to comply with Australian laws. It's slightly qualified in that it requires charities to act in a way that under the Commonwealth, state or territory law could be dealt as an indictable offence, being a serious crime that is tried by a judge and jury, or a breach of law that has civil rather than criminal penalty of 60 penalty units or more. So this broadly allows the ACNC to investigate potentially serious breaches of the law. Now, in order to ensure this standard is met, the ACNC recommends being familiar with all the areas of regulation applicable to your charity, having processes in place to protect your charity's finances and assets, and having a process in place to ensure the charity meets its legal obligations. There is actually a proposal currently in place to extend the scope of Governance Standard 3. So these amendments to Governance Standard 3 are proposed to ensure that charities must not engage in conduct that may be dealt with as a summary offence relating to real property, personal property, or persons under an Australian law. And also charities must take reasonable steps to ensure their resources are not used or continue to be used to promote or support the charity to engage in unlawful activities prohibited under this standard. So it is a proposed slight extension to Governance Standard 3, something to consider. The consultation in relation to that measure is currently open. In relation to Governance 4, this requires charities to take reasonable steps to ensure that its board or committee members or trustees, broadly its responsible persons, are not disqualified from managing a corporation under the Corporations Law or being a responsible person by the ACNC Commissioner within the previous 12 months. So obviously there's some compliance activities that charities can undertake to ensure that they are complying with this standard, for example, requiring all responsible persons to sign an annual declaration, ensuring they're not disqualified, and requirement to advise the charity if any of those circumstances change. In relation to Governance Standard 5, this requires charities to take reasonable steps to ensure that duties apply to responsible persons and that those persons follow those duties. And they are duties to act with reasonable care and diligence, to act honestly and fairly in the best interests of the charity and for its charitable purpose, not to misuse their position or information that they gain as a responsible person, to disclose conflicts of interest, to ensure that the financial affairs of the charity are managed responsibly, and not to allow the charity to operate whilst it's insolvent. So, for example, if you've got a charity that's consistently running at a deficit, that may be a red flag here, not just from a financial perspective, but also in relation to Governance Standard 5, where you've got board members with potential conflicts of interest. Again, they need to be disclosed here to ensure there's no breach of Governance Standard 5. Finally, just to move on to the sorts of health checks that we undertake to ensure compliance, not just with the ACNC governance standards, but also the requirements for an income tax exemption in Australia, and also to ensure a charity is complying with its GST and employment tax obligations. So typically if we do a review of a charity, maybe on an annual basis, confirmation that there's no breach of the In Australia requirement, confirmation that a charity is operating in accordance with its governing rules, and it's applying its income and assets solely for its charitable purpose. Also, we consider deductible gift recipient endorsement requirements. There are separate requirements in relation to deductible gift recipients in terms of receipt requirements, etc. So we do also look at that. Finally, we would consider the ACNC governance standards as applied to that particular charity. And for example, if we're reviewing the deductible gift recipient endorsement, we would go through and do a checklist, including looking at the specified categories here, and finally confirming that the organisation has issued receipts for gifts and deductible contributions it has received. That's it from me from a tax perspective, but look forward to any questions. Thank you.
Thanks, Catherine. So this brings us near the end of our webinar today. We've listed here for you the key takeaways from today's webinar. We encourage you to use the flow diagram to help determine which accounting standard applies to your transaction, the revenue standard or the income standard for not-for-profits 1058. Where you have an arrangement that requires you to pass funds to another person or entity, think hard about whether you need to recognise a financial liability and the impact on your income statement. What steps would you like to take this reporting period to tell your story on how you're performing against your objectives? And what do you need to do now to put this in place? Are you confident that you're meeting the ongoing requirements for DGR status or income tax exemption status, particularly with respect to the in Australia condition? And consider whether your organisation is complying with the ACNC charity governance standards where you're registered with the ACNC, or if you would like to benefit from a charity health check review. Hopefully today's presentation has assisted in clarifying these issues.